In 2026, Abbott India generated nearly 7,000 crores in revenue.
Right.
But instead of aggressively, plowing that massive pile of cash into wild new drug research or buying up biotech startups, they did something that might actually surprise you.
Oh, definitely.
They took almost 3,000 crores and just locked it into basic fixed deposits.
Which is wild for a pharma company.
Yeah, exactly. So today, we're opening up their audited financial diary, specifically their results for the year ended March 31st, 2026, which they submitted to the Bombay Stock Exchange to find out why. Welcome to the deep dive.
Glad to be here.
Our mission today for you listening is to translate a really dense, highly technical corporate filing into the actual strategy of how a gigantic pharmaceutical entity operates, allocates its capital, and, survives in a highly unpredictable regulatory environment.
It is always so revealing to look past the glossy investor presentations and just go straight to the audited financials.
Right, because the numbers don't lie.
Exactly. My balance sheet doesn't care about a company's PR narrative. The numbers are the undeniable footprint of executive decision-making. I mean, the money went exactly where they prioritized it going.
Okay, let's unpack this. Because to understand the strategy, we first have to look at the scoreboard.
Right.
We need to measure the sheer volume of capital moving through their system. And looking at Abbott India's 2026 numbers, the scale is genuinely formidable.
It really is.
If you're reading through this filing with us, the first thing that jumps out is the top-line revenue from operations. In 2025, they were sitting at 6,409.15 crores. By the close of March 2026, that expanded to 6,929.05 crores.
That is a very healthy revenue trajectory. But, anyone who follows corporate finance knows that top-line expansion doesn't automatically equal success.
Right. I mean, you can easily grow your revenue to 7,000 crores while spending 8,000 crores to do it.
Precisely. The real metric of operational health is whether that revenue growth is actually translating to the bottom line.
And in this case, it absolutely is. I mean, their total profit for the year jumped from 1,414.44 crores up to a highly impressive 1,552.02 crores.
That's a massive jump.
It is. That means their earnings per share, their EPS, rose from 665.62 to 730.36.
Wow. But, analyzing this, I noticed a very specific tension in their expense columns. Their employee benefits expense surged significantly.
I saw that too.
It went from 587.54 crores in 2025 up to 668.82 crores in 2026. So we're looking at an 80 crore increase in just human capital costs.
Right.
So my question is, if you're running this business and your workforce is suddenly costing you that much more, how are you still outpacing your revenue growth with your actual profit margin? Like, is this kind of growth purely about selling more, or is it about managing the expenses we see creeping up?
Well, what's fascinating here is how they manage their operational leverage to absorb those creeping fixed costs.
Okay.
You don't hit 1,552 crores in pure profit just by selling a higher volume of the exact same product mix if your underlying labor costs are surging. So they have to find money somewhere else.
Exactly. You have to find structural efficiencies elsewhere in your supply chain. And they successfully absorb those rising operational costs while still widening their profit margin.
Which brings us to the cost of materials consumed. I was combing through their raw material expenses, and despite that massive leap in overall sales volume, their actual cost of materials dropped.
Not just as a percentage either.
Right. In absolute terms, it fell from 621.12 crores down to 613.88 crores. They generated over 500 crores more in revenue, but spent less on the materials to make those products.
That is the absolute hallmark of pricing power and an optimized product mix. If your material costs are dropping while your revenue is spiking, it tells us they're likely shifting their sales focus toward higher margin formulations.
Or maybe they negotiated incredibly favorable terms with their active ingredient suppliers.
Exactly. They aren't just pushing more boxes out of the warehouse. They're extracting more value out of every single box they ship. And that margin expansion completely neutralizes that 80 crore bump in employee expenses.
It's an incredibly disciplined way to operate. I mean, they are actively optimizing their cost of goods sold to fund the rising cost of their workforce while still passing an even larger chunk of profit down to the shareholders.
It's a tricky balance to strike.
It is, but that operational discipline creates a completely different kind of problem.
A good problem to have, though.
True. Because when you're operating this efficiently and you're clearing over 1,500 crores in profit, you are suddenly sitting on a mountain of newly earned cash. And that cash has to go somewhere, It doesn't just sit in a giant vault.
Right. Capital allocation is arguably the most critical job of any corporate board.
Yeah.
Generating cash is an operational victory, but deploying that cash is a strategic one.
So here's where it gets really interesting. I was tracking the deployment of that capital. Their total assets grew from 5,917.31 crores to a very robust 6,501.93 crores.
Okay.
But if you look at their actual cash and cash equivalents, like the highly liquid capital sitting in their current accounts, it actually shrank.
Oh, wow.
Yeah, it dropped from 560.59 crores down to 442.33 crores. So their overall wealth expanded by hundreds of crores, but their checking account balance went down. The capital was actively moved.
And, a shrinking cash balance in a highly profitable year is a very clear signal of aggressive capital deployment. The question is, where did they redirect all that liquidity?
Well, I found it in the cash flow statement, and it is a massive deployment. They took 2,888.18 crores and parked it in fixed deposits with maturities of more than 3 months.
That is a huge chunk of change.
Right. And alongside that, the board of directors recommended a staggering dividend payout to shareholders. We're talking about a final dividend of 525 rupees plus a special dividend of 131 rupees per equity share.
Incredible.
And to put that in perspective for you listening, the face value of an Abbott India share is just 10 rupees. So they're paying out a combined dividend of 656 rupees on a 10 rupee face value.
A 6,560% payout on face value is an absolute mammoth of a shareholder reward. It's almost unheard of.
Yeah, but I really have to push back on the broader strategy here.
Okay, let's hear it.
Look, they're a massive player in the pharmaceutical sector. That's an industry defined by relentless innovation, patent races, and massive capital expenditures for research and development.
Oh, sure.
Yet they're taking nearly 2,900 crores and dumping it into fixed deposits. That sounds like my grandfather's savings strategy.
I get what you're saying.
I mean, isn't that incredibly conservative, like risk-averse for a dynamic pharma giant? Why aren't they deploying that capital into acquiring biotech startups or building cutting-edge research labs? Shouldn't they be inventing things? Parking billions in an FD seems like a strategy for preserving wealth, not aggressively growing an empire.
It does look overly cautious if you evaluate it strictly through the lens of traditional pharma growth models.
Right.
But looking at the statement of cash flows, this is actually a masterclass in capital allocation discipline. You have to consider the yield they're generating without exposing themselves to operational risk.
Okay, break that down for me.
So, by parking that 2,888.18 crores in fixed deposits, they generated 384.53 crores in pure interest income over the year.
Wait, over 384 crores just in interest.
Just in interest.
Wow.
It's essentially a highly profitable side business that does nothing but earn interest on their existing wealth. They are operating from a philosophy of building an impenetrable war chest.
So it's about stability.
Exactly. When a company is generating that kind of cash, they have the luxury of choice. They're utilizing that cash flow in two precise ways.
The dividends and the FDs.
Right. First, they deliver that massive 656 rupee combined dividend, which keeps institutional and retail investors completely anchored and exceptionally happy. And second, they lock the remainder in safe, liquid, interest-bearing instruments.
So by avoiding the temptation to just acquire a startup for the sake of growth, they're avoiding the risk of a value-destroying merger.
Precisely. A war chest strategy ensures absolute stability without risking capital. If a genuine, once-in-a-decade acquisition target suddenly becomes available at a distressed price, they don't have to navigate credit markets or issue new debt at terrible interest rates.
They just use the cash they already have.
Yeah, they have billions in liquid fixed deposits ready to be deployed instantly.
But, having a mountain of cash in fixed deposits isn't just a luxury, it's a defense mechanism. Because making money and paying it out is the fun part. But running a business in the real world means dealing with shifting government rules.
Very true.
Which brings us to arguably the most revealing footnote in the report. The real-world friction of operating a business at this scale. There's a fascinating disclosure in Note 4 of the filing.
Ah, the legislative overhaul regarding the labor codes.
Yeah, exactly. Note 4 outlines that on November 21st, 2025, the government of India notified 4 new labor codes. These 4 codes covering wages, industrial relations, social security, and occupational safety essentially consolidated and replaced 29 existing disparate labor laws.
That is a massive legislative shift.
It is. And Abbott had to assess the implications of this entirely new legal framework, and it resulted in them recognizing an incremental cost of 18.0 crores embedded within their employee benefit expenses for the year.
Yeah. If we connect this to the bigger picture, this is exactly why companies of this magnitude insist on holding that massive cash buffer.
Right. It's like an HOA suddenly changing the neighborhood rules and forcing you to pay a new assessment fee out of nowhere.
That's a great analogy.
So what does this all mean? Did Abbott actually change how they treat workers, or is this just an 18 crore paperwork and compliance tax?
It's largely the latter. This 18.0 crore hit isn't an abstract number, and it's not due to a mismanaged product launch or a sudden spike in raw material costs. It is the direct, real-world financial friction of adapting to sweeping national policy changes.
So it's pure administrative friction. When you condense 29 laws into 4, you're fundamentally redefining what constitutes basic wages versus allowances.
Right, which triggers an immediate systemic domino effect across the entire organization. When the legal definition of a wage changes, every single Provident Fund contribution, gratuity calculation, and leave encashment policy has to be entirely re-audited and recalculated.
Yeah, you're bringing in specialized legal counsel to interpret the new codes. You're hiring HR consultants to rewrite employment contracts. You're paying enterprise software vendors to completely reconfigure your payroll.
Exactly. And Note 4 explicitly mentions that they're continuing to monitor the finalization of the rules to provide appropriate accounting effects as needed.
Meaning there might be more costs coming.
Oh, almost certainly. That language is a very clear signal to the market. It means this 18.10 crores is just the initial wave.
Wow. Which completely justifies the conservative capital allocation we were just critiquing.
Yes, it does.
If your regulatory environment can suddenly force you to absorb tens of millions in unplannable compliance costs just to maintain the status quo, you cannot afford to be over-leveraged. You need that 3,000 crore war chest so you can absorb these macro-level shocks without having to divert funds from your core operations.
It really separates the resilient enterprises from the fragile ones. A fragile company has to take on debt to manage an unplannable 18 crore regulatory hit.
But a resilient company absorbs it, updates their software, and still widens their profit margin by the end of the quarter.
Precisely.
So we've watched this massive machine in motion. They're driving 7,000 crores in revenue. They're successfully navigating complex regulatory overhauls and shifting billions of rupees into fixed deposits while aggressively rewarding shareholders.
It's impressive.
It is. But whenever you're dealing with financial engineering at this magnitude, the immediate question for you, the listener, or an institutional investor, is verification. How do we, or the stock exchange, know we can actually trust these numbers? How do we know the 18.10 crore hit wasn't actually 50 crores being masked by creative accounting?
Enter the auditors. This is why the statutory audit is the foundational pillar of the public markets.
Right.
Without independent verification, a financial statement is just a corporate marketing document.
And in this specific filing, the statutory auditors are Mrs. Walker Chandiok & Co., LLP. They went through the books and issued an audit report with an unmodified opinion.
An unmodified opinion is the absolute gold standard outcome for a corporate audit.
And to back that up, Abbott's chief financial officer issued a formal declaration confirming that this unmodified opinion ensures the financials give a true and fair view in conformity with Indian accounting standards.
Which is exactly what you want to see as an investor.
Well, let me stop you there, because the terminology used in auditing always feels incredibly understated to me. To a layperson, the phrase unmodified opinion doesn't sound like a gold standard. It sounds rather passive, like saying, well, we looked at it and we didn't change anything.
I can see how it sounds like that.
So does an unmodified opinion mean a company is perfectly run, or does it just mean that they didn't lie on their math test? Like, are they saying that parking 3,000 crores in fixed deposits is a brilliant business move?
This raises an important question about the boundaries of an auditor's mandate. An auditor is not a management consultant.
Wait.
They are not a strategic advisor. They're absolutely not evaluating the wisdom of the capital allocation.
Think of it like a municipal building inspector.
Exactly.
When you buy a house and the inspector signs off on it, they aren't telling you if the house is a good investment or if the interior decor is ugly. They're just verifying that the foundation isn't currently cracking and the plumbing actually exists where the blueprint says it does.
That is the perfect analogy. An unmodified opinion is a formal declaration that the financial statements are free from what the industry calls material misstatements.
So the numbers are real.
Yes. The auditors at Walker Chandiok & Co. are explicitly stating that when Abbott claims they took an 18.10 crore hit for the new labor codes, the auditors tested the payroll recalculations and verified the legal invoices. They are authenticating the historical record.
So the CFO's declaration that it gives a true and fair view means the math checks out, and the public markets can trust the numbers to make their own strategic judgments.
Precisely. They are verifying the past, not predicting the future.
Right. And as we look to the future, there is one final critical piece of data in this filing that brings this entire strategic narrative into sharp focus. And it's buried in Note 6 of the report. The document explicitly declares that Abbott India operates under only one single business segment.
Yes.
And that segment is pharmaceuticals.
They are completely undiversified in terms of corporate structure. No consumer goods division, no separate medical devices wing acting as a hedge. They are a pure play pharmaceutical operation.
Which brings our deep dive to a really fascinating conclusion. Because for you listening, we've taken what initially looked like a sterile stack of dry financial tables and uncovered a highly dynamic story of Abbott India navigating 2026.
Yeah, it's quite a story.
We saw them drive massive profits, clearing over 1,500 crores. We saw them reward shareholders with huge dividends and conservatively bank cash in fixed deposits. We watched them seamlessly absorb an 18 crore regulatory hit from those new labor codes, and finally, they got a completely clean bill of health from their auditors.
It is a profound demonstration of operational efficiency paired with immense capital restraint.
Immense restraint.
Yeah.
Which leaves us with a lingering, provocative thought to consider.
Oh!
Yeah. Abbott India has deliberately placed all of its economic eggs into one single basket: pharmaceuticals. Now, if a massive, highly efficient company has its entire corporate existence tied to just one highly volatile industry,
Right.
and they actively choose to park billions of extra rupees in conservative fixed deposits rather than diversifying their revenue streams,
What does that tell us about how their board views the immediate future?
it suggests a level of anticipation. They are holding their cards very close to their chest.
Are they simply waiting out an incoming macroeconomic storm, content to earn risk-free interest while their competitors over-leverage themselves? Or is that 3,000 crore war chest sitting there because they're quietly, patiently saving up to buy a brand new basket entirely?
That is the big question.
It's something for you to ponder the next time you see a corporate earnings headline cross your feed. What is the real strategic story hiding behind the math?